I'm honored that you're here, and I hope I'll be able to make it interesting enough for you so that you do not regret your choice of choosing MPC and not PDC or IEC. So I have prepared a few slides. I'll try to run quickly through them to give you an insight into where we are into our different macroprudentially related projects, and I hope then to have some time left for Q&A at the end. I realize there is a coffee break already at 10:30, so let's see how we can make best use of our time. So again, I always like to start with advertising our work, so please, for those of you who haven't done so yet, download our GMAR. It basically summarizes and goes into detail much more than what I'll be able to do in the few minutes here today. And it's a really nice overview of the macroprudential analysis that we perform at IAIS. I want to stress the representativeness of the GMAR. So today we collect data of around 60 of the largest international insurance groups. More than 50 supervisors participate, and we are able to cover more than 90% of the gross written premium worldwide. So that really makes it a representative data sample, and that really helps us to perform an adequate analysis. And that analysis, as you know, is really fed into the analysis that FSB undertakes at a cross-sectoral level. So it's really key for us at IAIS to have you participate, both supervisors but also insurers, to this exercise. I think the better data lead to better analysis, better outcome, and really informs FSB on the macroprudential aspects of the insurance sector. We are heading into a crucial year because in 2025 we end another 3-year review process in which we try to convince the FSB that a holistic framework is a good thing. I think so far we have achieved that goal, but you cannot be complacent, and we need to stay on top of things in order to continue the good work that we have started. What we try to do as well is to give you, and all of you that participate, feedback. We try to set up reports that we send back to both participating insurers and supervisors. Hopefully it helps you to benchmark your own result versus the result of the sector. And also for supervisors, it helps to benchmark their insurance market with the rest of the world. So thank you for participating, and everything I will tell you today is actually based on the data that is sent. We also have 2 themes in focus. We have been repeating them a lot the last few months. I'll go into detail to each of them later on. In global, I think we can say that if you look at solvency, if you look at profitability, if you look at liquidity, the insurance sector on aggregate has remained resilient, has performed strong, and also the immediate outlook into the near future looks good. I think that is the first and important message that we derive out of the GMAR. And it means that despite an environment that is on a macroprudential level characterized by a lot of uncertainty, geopolitical risks, uncertain and sometimes volatile financial markets, I think the fact that the insurance sector has showed his stability and resilience is an important message to give to the outside world. Should we be complacent? No, there are risks on the horizon, and that is something we need to continue to monitor. We've also noticed that the aggregate systemic risk score of insurers have increased with 5.3% in 2023. Now, this remains well below the systemic risk score of banks. I really want to emphasize that. And is also, and this is an interesting finding, it is largely driven by one of our indicators, which is the level 3 assets. It is characterized by the fact that many of you have moved to IFRS 17, 19, or 9, and that what was previously sometimes valued at amortized cost, these days is valued at fair value, and so often ends up in the level 3 asset bucket. There is work for us to do at the IAIS to look into this indicator. To which extent is it driven by accounting changes? What do we really want to measure? Is it the complexity of the assets? Is it the liquidity characteristics? There is some work to do, and if we look into the FSB review point next year, I think we need to find a solution by the time that we present our updated methodology to the FSB and make sure that we use this indicator in a correct way. Our first theme really looks and zooms into the current macroeconomic environment, the uncertainties that characterize that environment, and the way insurers cope with those uncertainties. As I said, inflation, uncertain economic growth, geopolitical tensions, that's what today characterize our macroeconomic environment. And the specific areas of attention that we focus on at IAIS are listed below. So we look into interest rate and liquidity risk. We have seen certain insurance markets, for instance, where lapses have increased, where there is more surrenders than there were before. We have also seen in certain markets how derivative activity could lead to certain margin calls, so that's also something we monitor. Those are interesting areas in terms of liquidity risk. On credit risk, we know that certain governments, certain corporates, they have certain indebtedness, high indebtedness, and so the debt sustainability question and the potential impact on spreads and ratings is also something we monitor together with a particular focus on certain commercial real estate markets. Transmission channels on geopolitical risk, I'll come back to that in more detail later. That is really a very hot topic. Trying to understand how the different dynamics of geopolitical risk, how those could lead to an impact on the balance sheet of an insurer. So trying to understand those transmission channels is key. And one of those transmission channels could be, for instance, through cyber events impacting operational resilience. Climate-related risk is something we have been monitoring for a few years now and will continue to do so. And digitalization and AI, of course, are topics that are so recent that we cannot not discuss them in our GMAR. On the geopolitical risk, which is the left-hand side here, we really try to understand how things like political instability, trade disputes, military conflict, cyber threats, how could that translate to an insurance balance sheet? You can imagine effects on price, driving upwards inflation, cyber threats leading again to operational resilience concerns. Trying to translate these transmission channels in what that could mean for an insurance balance sheet is not so easy. We've tried to, in a very graphical way, illustrate that in the GMAR, which transmission channels, in our view, deserve particular attention. But that's really an area that is under continuous development and where your feedback, of course, is appreciated. AI is really an umbrella term. It goes from artificial intelligence, machine learning, deep learning to generative AI models. We know how these models can help insurers make their processes more efficient. But again, there are areas of attention such as operational resilience, cyber resilience that could be related to the use of AI models, and there are conduct-related aspects in terms of underwriting that also deserve a certain attention. So these two topics are elaborated in much more detail in the GMAR. Feel free to have a look at that. Our second theme, we've discussed that already in length already also yesterday during the roundtable. It basically focuses on the structural shifts we've seen in the life insurance market. Those are characterized by, on the one hand, the growing use of asset-intensive reinsurance, and on the other hand, the growing investments in alternative assets. Two short words here. On alternative assets, I think the main challenge for us as supervisors is to find a common view, a common definition on how to look at alternative assets, how to best monitor them, and how to align our supervisory reactions. For those of you that have followed the roundtable yesterday, we focus on key principles, key attributes such as illiquidity, complexity, and valuation uncertainty. And on the asset-intensive reinsurance side, I've explained also a few times that there is still quite a learning curve to go through also from us at the supervisory level. We try to identify the drivers of those transactions, be it the interest rates, be it pension reforms, demographic changes, anything that could influence the volumes in terms of asset-intensive reinsurance. We look at certain supervisory concerns in that area, such as potential concentration risk at either cedent or reinsurance level. The fact that it's quite complex, once you start zooming into these transactions, you see the wealth of detail that can be quite different. And I've said this morning already, it's an umbrella term, again, asset-intensive reinsurance, but if you look into the details, there are quite some differences in the different contracts. And that's also for us as a supervisor, with your help, I would say, to get a better understanding. For both of these areas, what we try to do is to go beyond looking at it only from a microprudential perspective, but also trying to understand the macroprudential implications. For instance, on alternative assets, what we also try to emphasize is what is the role of insurers in certain alternative asset markets. Could you bring stability? Could the long-term investment view of insurers help to bring stability in certain alternative asset markets, for instance? That is a key storyline also when we discuss with FSB, because they look at it from a cross-sectoral perspective, and trying to understand the role of insurers in certain of these markets is therefore key also from our side. On asset-intensive reinsurance, the macroprudential aspects are potentially related to risk concentrations in certain jurisdictions on the one hand, and on the other hand, certain potential pro-cyclical effects of certain contract features such as recapture risk. So this is very much ongoing work, and I again refer also to the issue paper that we tend to publish March next year for public consultation, and I would invite everyone to really participate to that consultation. Your feedback will be highly appreciated. Another public consultation which is currently ongoing is on the ancillary risk indicators. So ancillary risk indicators are indicators that we use in our macroprudential framework to monitor. They do not impact any risk score, but they do help us to monitor certain risk and trends. And the areas we are working on are derivatives, reinsurance, mark-to-model assets, liquidity metrics, and credit risk. So this public consultation is currently ongoing. Please participate. There is also a call foreseen for interested parties. I think it's next week, if I'm not mistaken. So please join us, and we'll be happy to answer any questions you may have. And it will really help us in developing these indicators, making sure that what we do is relevant, and also making sure that the data is available to monitor these different areas. Let me give you also a preview to next year. I've mentioned the issue paper. I've mentioned the publication in March 2025. So please do not hesitate to contribute. Maybe some attention to the last bullet point. An essential element of this issue paper for us at the IAIS is also looking at our supervisory toolbox and trying to check whether the current ICPs, whether the current supervisory material is fit for purpose, whether it really helps us in tackling the issues and helping to understand what is happening and trying to align our supervisory reaction. So also that is a key part of that issue paper. As I said, we're heading into 2025 where we will update our methodology, and we'll have another discussion with the FSB on the holistic framework. And last but not least, I haven't mentioned it before, we are working on a GMAR special topic which tries to assess the financial stability implications of natural NatCat protection gaps. You can think about impact on real estate values, impact on state budgets, anything that could happen in case you would have large protection gaps. Also very topical. What we're trying to do is to develop case studies that illustrate how natural catastrophe protection gaps could lead to implications on the bank balance sheets, for instance, through real estate, via mortgage loans, or on state budgets. So that is also very topical work, and we hope to get that ready next year, also to be published afterwards. Let me check. I think we're at the end. Yes. So that leaves some time for your questions. Feel free if you have any questions related to this work. If not, we can have a very early coffee break. It's up to you. I think there should be microphones in the room, right? For if you, so just. Oh, they're on the tables. Perfect. Yeah. Yeah, please. Let's hope it's worked, because yesterday we had some issues with some microphones.
Hello, is it working now? There we go. Okay, thanks. I'm Angus Scorgie. On the question of asset-intensive reinsurance, you've mentioned that it's where a material part of the investment risk is transferred. What's material?
Well, what we see, what we put under the umbrella of asset-intensive reinsurance is those reinsurance contracts where not only the liabilities but also the assets are transferred. So if from the point of view of the reinsurance contract, it basically means that the assets that come along with the liabilities are transferred in one go. So material means in this case everything that is related to the portfolio of liabilities. Yeah, I don't know who was, but please go ahead.
Thank you. I have a kind of very quick question. When you talk about asset-intensive insurance and some sort of actions on these things, do you differentiate between offshore financial centers and traditional onshore financial centers like US and Europe, as compared with Bermuda or Cayman?
Yeah, what we try to do is to make a distinguish between cross-border and non-cross-border asset-intensive insurance. I think we've already added some nuance in that respect into our GMAR, and we tend to go further on that road, also looking ahead to forward to the issues paper. So that we try to make that distinction, yes. Yeah.
Dieter, it's really helpful to understand when you're going to the FSB to talk about what potential unique role insurers might play because of the nature of our liabilities. I know that separately it was mentioned yesterday that there's a more general look in the strategy about the societal role of insurers, and that was mentioned in terms of protection gap. Is there any plan to expand that at all to actually look at the investment side as well? Because in some respects, actually, insurers are very well placed long-term liquid liabilities. You've got a climate transition, you've got infrastructure, the very things that insurers are well placed. For many of us, we see you can't disconnect the societal role of insurers in policyholders' perspective also from our investor role, and I wonder whether there's any likelihood that that will become a little bit stronger link?
That's a good question, actually. I think at some point, at least through our work here, and if we're able to demonstrate what the role is of insurers in certain financial markets, I think we could have arguments that can help us out in that discussion. Whether or not and how explicitly to link it with the societal role discussion, I think we'll need to see. But if you talk about funding the real economy, if you talk about contributing to growth, I think there is an argument in play here. For us to learn here is actually how does this role of insurers work. And so we do see that if you talk about private credit markets, that it was traditionally mainly the banks being involved there. You see more and more involvement of insurers. What does that mean? How to understand it? I think that is something we need to try to put onto paper, I would say. Yes.
Robert Neal, the American Property Casualty Insurance Association. Thank you for your insights this morning. I would just had a follow-up question on the Nat Cat protection gaps reference towards the end. I know the IMF and the IAIS put together a great panel at the World Bank IMF meeting in the fall that was very thoughtful on this, and hopefully that will continue. But would just ask, it wasn't clear to me, is the timeline like the spring for that work stream or later in the year? Do you have a sense of that yet?
I think it's later in the year, okay. And to give you any comfort here, we are actually working together with the World Bank on this topic. I think they have a lot of experience that also in emerging markets and how to understand how certain natural catastrophes, what the impact is. So it's really going into continuing into that road that we have constructed and which we hope to further work on. Now, this paper, I want to stress that because we've had long discussions, it is from a macroprudential perspective looking at financial stability implications. There's a lot of other work going on protection gaps, But via this paper, we try to contribute to that aspect of the discussion. Yes? Yeah, go ahead. Yeah, yeah.
So just going back to the topic of asset-intensive reinsurance, I think one bullet that was potentially missing on the slide on it, and it goes back to Helena von den Hagen's comments yesterday. I do think there is a need for regulators, supervisors to also understand the direct writer perspective, and specifically the risk management framework that we put in place when we transact, when we do these transactions. We're all focused on the exposure and the potential increase in exposure. Well, guess what? The direct writers are very aware of that as well. And as Helena gave some examples yesterday, we have conditions in the reinsurance treaties that sort of protect our policyholders. We have collateral, we have trust funds. So I think that is all part of the big picture. It's not just what do we do with an increasing exposure. Well, you've got to think about the risk mitigation that's in place as well.
I fully agree. It may have not been on the slide, but it's very much on our agenda. What we try to do is also educate supervisors a little bit in terms of what are the key features of a contract that you would like to understand as a supervisor. First of all, from a microprudential perspective, and hopefully at a later stage also from a macroprudential perspective. That's also why I said it may be one umbrella term, but if you go into deeper details, you see quite a wealth of different types of asset-intensive reinsurance contracts. And I think the discussion earlier was when is it asset-intensive reinsurance? Sometimes it's a gray zone. What we want to stress is first of all that we need to go through that learning curve as supervisors to better understand these transactions. And secondly, you see quite some different supervisory reactions these days. I have mentioned it before. You have supervisors, if you drop the word asset-intensive reinsurance, you get an allergic reaction saying, no way on my market. You have others who accept it. You have others who have supervisory approval processes prior to. So there's room for better understanding and alignment, I think. And I think the GMAR illustrates already that the quite of differentiated supervisory responses that we still see today on the markets. I don't know what time is it actually. 10:33, so you can enjoy your coffee break, but don't hesitate if you have any more questions left. I'll stay here for another 15 minutes.